Hi, I'm Kathy Scott, editorial manager at Institutional Investor Journals. Joining us today is Leah Modigliani, senior VP and multi-asset class strategist at Neuberger Berman in New York. She's also co-author with her grandfather of an article that appeared in the Journal of Portfolio Management called Risk-Adjusted Performance: How to Measure It and Why. Welcome.
Thank you.
Leah, your article introduces what's become known as the Modigliani risk-adjusted performance measure, otherwise known as M-squared. Why would an investor bother to measure risk-adjusted performance?
Well, total return is not the complete picture because it ignores risk, which is clearly a very important part of investing. So let me take a step back actually and frame the problem for us. If I tell you that a technology fund has a higher total return than a utility fund, I haven't really told you much about performance, because we know technology is higher risk on average, and we'd probably expect a technology fund to have a higher return than a fund of utility stocks. But what we might want to know is, how did those funds do after accounting for the difference in risk? So we base our work on the premise that before comparing the performance of different portfolios, they should be made equally risky so that we can compare them on an apples-to-apples basis.
So how does your measure work? How do you make portfolios equally risky?
We do that using leverage, literally meaning borrowing and lending. So take that technology fund. Let's say we want to use the S&P 500 as our benchmark, and let's say we're going to use volatility as our measure of risk. We'll see later that we can change those assumptions, but for now, let's stick with that. So I have this technology fund, and I'm trying to compare it to my benchmark, the S&P 500, and I need to bring down the level of volatility in that technology fund to get it to match the level of volatility in the S&P 500. So to do that, I sell off a fraction of the portfolio fund of the technology fund, and I add the cash or T-bills, some cash equivalent asset. And as I add the T-bills, I dampen the volatility. And I can dampen the volatility until it exactly matches that of my benchmark. Then what we say is, if that new portfolio, that 70-30 portfolio, beat the benchmark, then the original technology fund beat the benchmark on a risk-adjusted basis.
What about a lower risk fund? You don't want to keep adding cash to that, so how do you get it to match the risk of a benchmark?
Right, so for a utility fund, we want to do the opposite approach, really. So the utility fund is lower level of risk than the benchmark, presumably. So we want to bring up the level of risk, jack it up to match the level of volatility in the S&P 500. So to do that, we borrow and overinvest in that utility fund. So say we borrow 20%. In the end, we might be 120% invested in the utility fund. But we've brought up the level of volatility to make it exactly match that of the S&P 500. So at the end of the day there, what we say is if that new 120% portfolio beat the benchmark, then the original portfolio beat the benchmark on a risk-adjusted basis. And now I have all of the portfolios on the same risk scale, so I can then compare them apples to apples.
How do you calculate the answer, the M-squared measure?
Well, what we're doing here is really just creating these risk-equivalent portfolios. So in fact, our definition of the risk-adjusted return of any portfolio is simply the return on the risk-equivalent version of that portfolio.
So you're relying pretty heavily on the concept of leverage.
That's right. We're using the leverage to make the portfolios equally risky, and then we're measuring the performance. But the way we measure the performance of those portfolios is just the way we would for any portfolio. So we use leverage to make them equally risky, and then we just measure the returns. So for, say, that technology fund, in that example, we put the amount that's in the technology fund times the return of the technology fund, plus the amount in cash times the cash return. And similarly, for the other side of the equation, what we're doing is using the amount in the original fund times the fund return, plus the amount in cash times the cash return. But here, the cash return is negative because we're actually borrowing. So what we wind up doing is subtracting off the borrowing costs that were used to lever that portfolio. So it's actually catching all of that in this real world example. So leverage is really this great tool because it's very easy to adjust the risks of portfolios on paper or using an Excel spreadsheet. But it's also a really cool tool because you can actually use it in real life to adjust the risks of portfolios. So it's not just a hypothetical notion of performance. It's actually the performance that you would have achieved if you had levered or unlevered accordingly. And I think that is really an important part of what we're doing here, because it makes the performance not just some pie-in-the-sky notion of what somebody says is good risk-adjusted performance. No, it's the performance that you would have achieved if you had been in that position. And therefore, it makes the returns attainable. And I like to say, to point that out, that you, in fact, can eat the risk-adjusted returns. Because as you've probably heard people say that you can't eat risk-adjusted returns. Well, I say that's not true. Here, you absolutely can eat the risk-adjusted returns. They put food on the table. Why? Because you're measuring performance that actually can be achieved.
What got you started down this research path in the first place?
I learned in graduate school that the right way to measure performance was on a risk-adjusted basis. But when I got to Wall Street, I didn't find people doing that very much. Returns are always listed, without any adjustment, and it's sort of like the highest one wins. It's the best. That's the best performer. And so I started wondering why people weren't adjusting for risks, and I started looking at risk measures or risk-adjusted return measures. So very quickly I came to the Morningstar star ratings, and those do account for risk in their rankings. And so I think that's definitely a step in the right direction. But I was just looking for something a little more rigorous, a little more precise than just number of stars. And at the same time, I did want to keep it easy to understand. So I started looking into the more academic measures of risk that had this level of precision. And I looked at the Sharpe ratio and the Trainer ratio and Jensen's alpha and so on and so on. And I got pretty frustrated. So I just kept thinking, there must be a better way. There must be a way to adjust for risk that's more rigorous than star ratings, but easier to understand than fractions like the Sharpe ratio. Well, I'm lucky enough to have a grandfather who's a professor of finance. And so I began talking to him about this over the dinner table one night when he asked what I was working on at work. And the two of us put our heads together and came up with these various ideas. And that's really where this work came from.
But doesn't your measure rank portfolios in the same order that the Sharpe ratio does?
It does rank them in the same order. But the Sharpe ratio gives us answers that are sort of fractional form. So when we are looking at a Sharpe ratio, we might say, oh, the portfolio returned 20%, risk adjusted, it was 0.71. With our measure, what we're trying to do and what we've done here is say, oh, well, the total return was 20%, but risk adjusted, it was 15%. So we're giving numbers in a much more palatable form for many investors. It's just total return, it's risk-adjusted return, but it's just returns. It's just basis points, percentage points, rather than fractions or decimals, which is the way we look at Sharpe. So that's one way that our measure is really the same as the Sharpe ratio, or it gives the same ranking anyway. But we think it's a bit easier to understand.
So is that the only difference between M squared and the Sharpe ratio?
Yeah, the other way that our measure differs from the Sharpe ratio is just that this framework that I'm talking about is something that we rely on very heavily, and we use it to explain everything we do. So it's really just those same risk-return trade-off charts that every consultant uses and has, return on this axis and risk on this axis. And actually, that same framework where leverage is the tool to move around that same picture, it's really implicit in all of the work that Sharpe does. It's just that he doesn't discuss it or mention it in the context of his measure. And I think that leads to some confusion and misunderstandings. What we've tried to do is really look at the picture, using this framework to inform us about what should be done and how that can help us to understand variations on this theme or more complicated issues relating to this same fundamental analysis.
Is your framework itself original?
It's really the same framework of modern portfolio theory that we're all relying on. And that's why our ranking gives the same answer as the Sharpe ratio. Same portfolio framework, same measure of risk. And so these basic principles of modern portfolio theory come through in both, and we get the same ranking. But what we've tried to do here is, not focus on these very tiny numbers that are more difficult to use, but focus on just returns that are easier to understand. We've also decided not to focus on the risk measure here. It's not that I'm advocating total volatility. It's just that what I wanted to focus on is how do you adjust for risk once you've decided on a suitable measure? And that's what we're doing, and that's what we're using the leverage for.
What other practical questions can you answer with this framework? Can you choose another performance measure?
Sure. You can use a different risk measure. You can just plug in beta instead of using total volatility, say, if you want to look at it in terms of the beta of your portfolio, and you think that's the way to measure risk. You could also change the benchmark in our analysis. And pretty quickly, when you look at it on that same risk-return chart, you see that once you have everything lined up on the same risk level or same risk scale, you can lever all the portfolios up or you can lever them all down. Because in our analysis, we're just using the benchmark as a way to calibrate the risk of all of the portfolios and put them all on the same risk scale so that we can compare them apples to apples. There's other things that we see quite clearly by looking at this lens. For instance, what if you want to use more realistic margin rates and put in for your portfolio the actual rates you face in the market and make it more realistic? Can you do that with our measure? Sure, you can just plug them right in. And actually that has helped me understand things about the Sharpe ratio and also about other variations. For instance, people often take a shortcut where they look at what they call return to risk ratio. And all that is the Sharpe ratio, but it doesn't bother to subtract off the risk-free rate. So people just look at return to risk, and they say to me, well, why do I have to bother with the risk-free rate in the Sharpe ratio? I never really understood why that was there anyway. Why do you have to do excess return? But the way we look at the analysis, I can see that in the Sharpe ratio, that risk-free rate is just that borrowing and lending rate. It's the return on cash and the cost of borrowing cash. And so that is how Sharpe is accounting for the leverage in the portfolio. So he's actually leveling everything down to one standard deviation. We're choosing a higher level of volatility, something like maybe the market level of volatility. And in our measure, because we've done that, we can see so clearly the borrowing rate and the lending rate, and we can change them to be more realistic. But it's clear to me why now Sharpe subtracted off the risk-free rate. It's to get these accurate performance figures. And it seems to me realistic that you should include the cost of leverage in the portfolio if you're then going to measure the return of an amped up portfolio or a dampened portfolio.
So really, it's just that the cost of the leverage is more transparent in your measure than it is in the Sharpe ratio.
Yes, exactly. It's more transparent, if you like. It's really based on the same fundamental principles, the same framework. But I think using this framework and using this tool of leverage makes things stand out, makes things more transparent and much clearer in our view. So our measure isn't radical. The framework isn't new. It's not perfect. We're just trying to move things forward, continue the dialogue on risk, and figure out how to make real-world examples of what we're doing on paper.
So despite the fact that your research was originally published back in 1997, investors are using these concepts today.
Right. Today, you hear a lot of institutional investors talking about risk parity or risk-balanced portfolios or using risk budgets to do asset allocation. And that's really just these same principles we've just been talking about. It's the concept of looking at risk and using leverage as the tool to equalize or neutralize risk to create portfolios. So the notion of risk parity helps us focus on the idea of balancing the risks in our portfolios and making them more equal across different asset classes. In its simplest form, that means that a risk parity portfolio might look at levering up the bond assets to match the level of risk in the stocks in that portfolio. So in that case, you're really just over-investing or overweighting bonds to get them to match the volatility of stocks. And that's the concept of risk parity.
Is this concept appropriate for all investors?
Well, whether or not investors should implement risk parity is really a difficult decision, and it's something I leave up to individuals based on their risk preferences and their advice from their advisors. But the basic concept here, the way I think about it is that really, if you were going to do risk parity, you'd want to match the future risk of bonds to the future risk of stocks. Well, none of us knows the future. So industry standard is to just take a period of the past and use that as our best forecast for the future. Well, of course, that could run into trouble if, for instance, there's a change in the market environment and all of a sudden the past volatility isn't a good picture of the volatility to come. But all of these issues can be broken down in sort of more manageable ways by using this framework of risk parity or leverage as a way to neutralize risks. To get a better handle on risk parity, what I had to do for myself was think about under what conditions would a risk parity asset allocation give me the same asset allocation as a good old mean variance optimization. And when I can see that, that really helps me understand the underlying assumptions and brings out this clarity again in how leverage can be used and used to address, whether it's how to measure performance or how to balance your risks, as the risk parity approach says. It really can be a very powerful and insightful tool. And I am lucky enough here at Neuberger Berman in the quantitative strategy group. My colleague Y. Lee is really an expert on risk parity. And so I just go to him when I want to ask about how we should implement some of the ideas for our own institutional clients.
Great. Thank you for joining us today and giving us your insights on this evolving topic.
Thank you.